In April, I cleared the decks, 12 positions out, mostly to cash. This month, I'm deploying 16 buys funded by fully exiting 2 positions that have done their job, AT&T and Ping An Insurance. The idea here is simple. After a month of profit taking, I'm rotating into a diversified set of opportunities that look materially undervalued or are sitting at inflection points. First, healthcare. And I want to start with Novo Nordisk. Q1 revenues beat estimates by 34%. But here's the thing. Obesity care sales surged 22%. Wegovy, Ozempic, the whole category is still accelerating. Novo is the scale leader, and so I'm in. But I'm not putting all of my biotech eggs in one pharma basket. Ginkgo Biotech, ticker DNA, has been crushed after a rough quarter. Yes, Q1 revenue dropped 49% because they're restructuring, but synthetic biology, real protein fermentation, not just DNA sequencing, is the next frontier. After a cleanse, Ginkgo is intriguing. Recursion Therapeutics, ticker RXRX, is also beaten to death. It lost money in Q1 and revenue missed. But this is an AI drug discovery company, and AI drug discovery is going to change pharmaceutical timelines forever. So again, I'm happily accumulating here. Finally, Centene, the Medicaid play that nobody's watching. They just crushed Q1 earnings. Earnings per share beat by 58%. Revenue beat by 5% and raised full-year guidance. It's healthcare services, not just pharma, so it's a buy for me. Gaming was dead in April, now it's rising from the ashes. Ubisoft is unprofitable, yes, but the studio is clearing its slate and focusing on fewer, bigger franchises. The chart to me looks to be printing a bottom, the same with Playtika. Casual gaming is resilient. Both are the kinds of companies that look terrible at the bottom, but outstanding on the way out. And then there's Riskified, a fraud detection platform for e-commerce and gaming. As payment volumes recover and merchants get stricter on chargebacks, this company's moat becomes more valuable. So I'm adding to my position. Teladoc rounds out this group. Telehealth got crushed, but it's not going away. Revenue beat estimates in Q1. The stock is nowhere near its highs. To me, this is a real asymmetrical bet. Next, I want to look at semiconductors. Skyworks Solutions just beat Q2 expectations, and analysts raised their outlook. The thesis is simple. iPhone strength and AI in mobile. I'm also looking at AMS Osram. They make optical sensors and LEDs. Every AI server needs optical. Every smartphone needs optical. So for me, this is a picks and shovels infrastructure play. And it's been sleeping while everyone else chases pure play AI software. Then there is the software layer. C3 AI is the infrastructure layer for how enterprises actually deploy AI. And Resolve AI rounds out my AI buys. This generative AI specifically built for retail and e-commerce, solving the problem of how retailers actually use AI to optimize inventory, pricing, and customer experience. The stock has been beaten down significantly from its highs, and 6 analysts have a strong buy on it. Moving on to digital infrastructure and recovery plays. Ocado lost money, but it's the infrastructure backbone of online grocery in the UK and the EU. Retail is online now. Eventually, Ocado gets margin. I'm buying the beatdown infrastructure. PayPal also looks like the kind of generational opportunity that appears once every cycle. It's been absolutely crushed, but payments are structural. Competition is real, but after this kind of washout, I'm buying here. Finally, 3 names for income and portfolio ballast. The first one is Trig, the Renewables Infrastructure Group. This is a UK investment trust trading on the London Stock Exchange with a double-digit dividend yield. Quarterly dividend payments, exposure to 36 wind and solar assets across the UK, France and Ireland. This is the decentralized energy transition. Then moving to Adidas. It has a price to earnings ratio of around 20 with low single-digit dividend yield. The stock has recovered, earnings are back, cash flow is back. It's one of the world's best apparel franchises And for me, I think it's really trading at a discount. So where does the cash come from to buy all of these new stock positions? Well, as I said, it's from 2 full exits. AT&T first, I held this one for the yield, but now I want capital appreciation vectors instead. Ping An Insurance second. China property fallout, regulatory overhang, the recovery we expected just hasn't materialized. So I'm out now with a small profit. So there it is, 16 positions, 2 exits, still carrying meaningful cash because the opportunities aren't everywhere, but where they are, in unprofitable turnarounds with real inflection points, in structural healthcare growth, in dividend infrastructure, in the semiconductor supply chain, that's where I'm pulling the trigger. So that's it for this month. Follow me on eToro as EdWhite1 for real-time portfolio updates, and I'll see you in June.